Silver just collapsed 7% in 2 hours. CME raised margins overnight, 65% increase, emergency level. The sell-off was instant, violent, algorithmic. I'm watching physical dealers pull inventory, premiums spiking while paper crashes. This is not a normal correction. This is forced liquidation. The same playbook from 2011, the same manipulation from 2020. Paper silver is breaking one direction, physical silver is breaking the other, and the banks know exactly what they're doing. Something systemic is breaking, and they just hit the panic button. Here's exactly what happened in the last 48 hours. Sunday night, 11:47 p.m. Eastern, CME Group issues margin requirement increase for silver futures. The new maintenance margin, $14,000 per contract, up from $8,500. That's a 65% increase overnight. No warning. By Monday morning Asian session, silver is already bleeding. The cascade starts slow, then accelerates. Algorithmic selling triggers stop losses. Stop losses trigger more algorithms. Within 120 minutes, silver drops from 32.80 to 30.50, 7% erasure of value. Roughly $3.2 billion in paper wealth vaporized. But here's where it gets strange. I'm monitoring physical dealers in real time. SD Bullion, JM Bullion, APMEX. Every major distributor. And I'm seeing the opposite reaction. Premiums aren't dropping, they're rising. 1 ounce American Silver Eagles, $6.50 over spot this morning. They were $4.80 on Friday. That's a 35% premium increase while the paper price is collapsing. 100 ounce bars, delays pushing to 3 weeks. They were same day shipping last week. The disconnect is expanding. Paper traders are panic selling. Physical buyers are panic buying. I'm watching two different markets react to the same event in completely opposite directions. Now the CME will tell you this is standard risk management. Volatility increased, so margin requirements increased, perfectly normal protocol. But the timing is surgical. Silver was approaching $33, critical resistance level from the 2012 highs. Momentum was building, retail interest was surging, and then, at the exact moment of breakout potential, the emergency brake gets pulled. This isn't risk management, this is price management. And if you understand what margin hikes actually do to leveraged positions, you understand why this works every single time. Let me explain how this margin trap actually functions. Most futures traders use leverage. That's the entire point of the futures market. You control $165,000 worth of silver with an $8,500 margin deposit. That's 20-to-1 leverage. Now the CME suddenly says you need $14,000 instead. You have two choices: deposit $5,500 more cash immediately or close your position. Here's the problem. Most traders don't have that extra cash sitting ready. They're already leveraged to their risk tolerance, so they're forced to sell. Not because their thesis changed, not because silver fundamentals deteriorated, but because the exchange changed the rules mid-game. And when hundreds of traders are forced to sell simultaneously, the price crashes, which triggers stop losses from other traders, which creates more selling pressure, which pushes the price lower, which triggers more stop losses. It's a liquidation cascade, automated, predictable, devastating. The beauty of this mechanism, from the bank's perspective, is that it's technically legal. The CME has the authority to adjust margins whenever they determine risk has increased, and silver volatility did increase, so the justification exists on paper. But look at the pattern. 2011, silver hits $49, CME raises margins 5 times in 8 days, silver collapses to $26. 2020, silver breaks above $29 in pandemic chaos. CME raises margins, silver pulls back to $23. 2022, silver pushes toward $27 as inflation surges. Margin hike, pull back to $21. And now, 2026, silver challenges $33, the highest level since 2013. Margin hike, instant 7% crash. Every single breakout attempt in 15 years has been met with the same response. You can call it coincidence once, maybe twice. But when it happens at the exact same technical level during the exact same momentum conditions every single time, that's not risk management, that's pattern suppression. And the question you should be asking is, who benefits from keeping silver under 33? The most important parallel is 2011, because that's when they perfected this playbook. January 2011, silver is 27. Momentum building. Retail investors flooding in after the financial crisis. The Hunt brothers' legacy still haunts the silver market, and everyone remembers what happens when physical demand overwhelms paper supply. By April, silver hits 49s, the fastest rally in modern history. Shorts are bleeding. Physical premiums explode to $8, $10 over spot. Mints can't keep up with demand. Then CME strikes. April 26th, margin increase. April 29th, another margin increase. May 2nd, another. May 5th, another. May 9th, 5th increase in 2 weeks. Margins go from $11,745 to $21,600. an 84% increase in 13 days. Silver collapses from $49 to $26 in 3 weeks. The most violent precious metals crash in history. Billions in leveraged positions liquidated, retail traders obliterated. But here's what didn't collapse: physical demand. Dealers were still sold out. Premiums stayed elevated for months. Mints continued rationing. The paper price crashed while the physical market remained tight. That's the secret they don't want you to understand. The futures market and the physical market are not the same thing. They're supposed to be connected, but in crisis moments they decouple completely. And every time they decouple, it exposes the truth. There's far more paper silver being traded than physical silver in existence. The LBMA estimates 5 billion ounces of silver are traded annually through derivatives and futures. The actual physical supply? About 1 billion ounces per year from mining. That's a 5-to-1 paper-to-physical ratio under normal conditions. But when everyone tries to take delivery at once, that ratio becomes a crisis ratio. And that's exactly what margin hikes prevent. They stop the paper market from converting into physical demand before the system breaks. Here's what I'm monitoring right now across physical markets. U.S. Mint. Silver Eagle production data shows 1.2 million coins sold last week. That's 37,200 ounces per day. Normal baseline is around 20,000. Demand is running 85% above normal. Perth Mint. Delivery delays on silver bars pushed to 15-18 business days. 3 weeks ago, it was 3 to 5 days. European dealers. Premiums on silver Philharmonics climbing. 320 over spot this morning. That's 0.90 higher than Friday close. And then there's the industrial side. Solar panel manufacturers are reporting supply tightness, silver paste availability declining, lead times extending from 4 weeks to 7 weeks. This matters because half of silver demand is industrial. Unlike gold, silver gets consumed. Solar panels, electronics, medical applications, once it's used, it's gone. The price crash on paper doesn't change that industrial demand. It doesn't reduce the number of solar panels being manufactured. It doesn't slow EV production. So you have this bizarre situation where the futures market is saying silver is worth less, but the physical market is saying silver is harder to get. Now look at the options market. Open interest on silver calls expiring in 90 days is sitting at 68,000 contracts. That represents 340 million ounces of silver. If even 10% of those go in the money and convert to delivery requests, that's 34 million ounces. The COMEX registered inventory right now, 41 million ounces. You see the problem. There's barely enough physical silver in the exchange warehouses to cover a modest percentage of potential delivery obligations. This is why margin hikes are deployed at specific moments. They reduce the probability that these call options finish in the money. They kill the rally before delivery pressure becomes a systemic issue. And I'm watching something else that concerns me. Lease rates on silver are creeping up. The 1-month silver lease rate hit 2.4% this morning. That's elevated. That suggests physical tightness behind the scenes. When lease rates rise, it means people who have physical silver are demanding higher returns to lend it out. That only happens when supply is constrained. Let's talk about who's on the other side of this trade. The bullion banks, JP Morgan, HSBC, Scotiabank, UBS, the authorized participants in the silver market. These institutions hold massive short positions in silver futures. Not for speculation, they're hedging physical inventory and managing client exposure. At least that's the official explanation. But here's what the COT reports show. The commitment of traders data, published by the CFTC every Friday. Commercial traders, the banks, have been net short silver by 280 million ounces on average for the last 2 years. That's 35% of annual global production. When silver rallies, those short positions lose money. Rapidly, at scale. A $5 move in silver on a 280 million ounce short position, that's $1.4 billion in losses. So when silver approaches breakout levels, these institutions have direct financial incentive to suppress the rally. And they have the tools to do it. They're the ones with trading relationships at the CME. They're the ones on the risk committees. They're the ones who benefit from margin hikes that force liquidations. Now, I'm not saying there's a phone call that happens where someone says, raise margins to crash the price. The system is more sophisticated than that, but the incentive structure is clear. The outcomes are consistent, and the pattern is undeniable. Here's the other part. While paper prices crash, what do the banks do on the physical side? They buy. JP Morgan accumulated 1 billion ounces of physical silver between 2011 and 2020. That's documented. The largest private hoard of silver in history, built during the exact period when they were accused of manipulating prices downward. Buy physical while suppressing paper. Classic accumulation strategy. They understand the difference between the two markets. They understand that paper manipulation can't change the physical reality forever. They're positioning for the moment when the paper system can no longer control the physical price. So where does this leave us? Short term, the technical damage is significant. Silver broke support at $31.20. Next level is $29.80. If that fails, we could test $28.50. The leveraged traders are wiped out. The momentum is broken. The breakout is dead. For the next few weeks, maybe longer, paper silver is going to consolidate. Fear will dominate. The narrative will shift to silver rally is over. But watch the physical market. If premiums stay elevated, if dealers remain sold out, if industrial demand continues tightening, that tells you the paper crash is artificial. And artificial suppression only works until it doesn't. The spring coils tighter every time they do this. The physical shortage gets worse. The industrial demand doesn't stop. The solar boom doesn't reverse. The electrical vehicle transition doesn't pause. And every margin hike, every forced liquidation, every paper price smash, it shakes out weak hands and transfers metal to strong hands. Here's what I'm watching for. 1. How long premiums stay elevated. If they normalize quickly, the physical market isn't as tight as it appears. If they stay high, that's confirmation. 2. Mint sales data. If the U.S. Mint, Perth Mint, and Royal Canadian Mint all report sustained elevated demand, that's a signal. 3. COMEX inventory. If registered silver continues draining from warehouses despite the price crash, that's the most important indicator. 4. Industrial reports. If solar manufacturers start reporting actual supply disruptions, not just delays, that changes everything. The paper market can be controlled with margin hikes and algorithm selling. The physical market can't. And at some point, those two markets are going to reconcile. When they do, the price discovery will be violent. This margin hike isn't the end of the silver story. It's a chapter in a much longer book. They've been managing this pressure for over a decade. Every breakout, same response. Every rally, same suppression. But the physical fundamentals keep building. The industrial demand keeps growing. The supply deficit keeps widening. Paper markets can manipulate price. They can't create metal that doesn't exist. I'm not telling you what to do with your money. I'm showing you the mechanics of what's happening right now. A 7% crash on a margin hike while physical premiums spike is not normal market behavior. It's crisis management, and crisis management only becomes necessary when there's an actual crisis brewing underneath. Watch the physical market. That's where the truth lives. The paper price is just the distraction.